Vanakkam, Namaskar, and hello to all the viewers and listeners of this episode of Fixed Income Markets with Sundaram Mutual Fund. On the domestic front, the high frequency indicators continued to be robust, although be softer than the prior month, indicating a resilient economy. For FY24, the GDP data printed at 8.2%, while GVA was 7.2%. While quarterly FY24 Q4 GDP grew at 7.8%, while GVA grew at 6.3%. Difference in GVA and GDP can most likely be explained on account of robust growth in Texas, while subsidies growth has not kept pace. Another factor to note is that if we look at GDP from expenditure side, the private final consumption expenditure has been muted, while gross fixed capital formation is growing at a healthy pace, showing the government hand in GDP growth. This could be one of the reasons for incumbent government losing in rural areas as consumption in rural areas has been lagging. RBI delivered a status quo as widely expected with two external members rooting for a 25 basis point cut and change of stance to neutral. Governor noted that due to favorable inflation growth dynamics, MPC is resolutely committed to bring inflation to 4% mark, which is facing headwinds from food inflation and volatile international commodity prices. He also reiterated that MPC will take Federal Reserve decisions as an input only, but will be oriented by local factors rather than following the Fed. Liquidity in the system went to a deficit, with RBI nimbly conducting two-way operations to keep the overnight rates anchored to the repo rate of 6.5%. Now, we anticipate that with the new government formation, the liquidity will come in surplus and remain in that mode for some time as government spending tends to be lumpy in addition to flows due to bond index inclusion. We also expect the RBI to modulate both durable and transient liquidity with tools available with it. Uh, what also we have seen in the MPC is that the governor has stated that they have asked banks to look at particularly the banks with high credit deposit ratio to look at that side, the liability side, which could basically means over a period of time this liquidity can get sucked out in case the capital expenditure from the private sector picks up and some borrowing or credit offtake remains as robust as it is currently, although the sequential momentum in credit has been uh, low. And we have been seeing that the deposit growth has been pretty robust. On the global front, each economy is charting its own course, and we can see a break from follow the Fed. We saw Bank of Canada cutting rates by 25 basis point, followed by the European Central Bank, and already some smaller economies doing that. We believe, as mentioned in earlier episodes, that global economy has been more polarized than before on account of deglobalization and localization. Read this as onshoring and friendshoring attempts. This has resulted in higher prices as a large supplier like China gets replaced gradually. China on its own looks like stabilizing with PBOC willing to support the local economy. Its attempt to become supplier in new age tech like electric vehicles and renewables is facing stiff resistance from advanced economies. In Japan, we expect a hike in rates as inflation continues to be much higher than the historical norm and wage rise been higher than expected. Global liquidity is likely to normalize as the Federal Reserve slows the pace of quantitative tightening. Keeping both domestic and global factors in mind, we expect the near term outlook on rates being uncertain as we may be near an inflection point where we may find the local factors like political stability rubbing off onto the economic growth as coalition politics need to be watched. On the global front, a rate action from Federal Reserve looks more probable in the Q4 of calendar year 24. While in India we think that if the growth slackens, and even if inflation is around 5%, we may see the first rate cut, which we think can happen in H2 of calendar year 24. Monsoon is on track and can augur well for the rural consumption, which can lift the spirits of the economy. Any balanced approach to lift consumption in the FY25 budget can lift the sagging spirits of the people and the rural economy. We continue to recommend long bonds to savvy investors, while other investors can continue to deploy funds as per their investment horizon and their risk appetite and matching their duration for the conservative investors in the cash management products, namely liquid, ultra short fund, money market fund, and low duration fund. While investors with incrementally higher risk appetite can deploy funds in mid duration schemes like short duration fund, banking and PSU, and corporate bond fund. Thank you for watching this episode. See you in the
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.